Good evening. We're going to go ahead and get started. I know some people are still grabbing food, but we do have some tuning in via live stream. So I'd like to first just thank everyone so much for being here, both our families that are here and those that are tuning in. We do events like this for you, and we are so grateful to have amazing families that we work with. So thank you for being here. Our entire 12-person Evans May Wealth team is here. So can I have everyone on our team raise your hand? Okay, perfect. So if there's an unfamiliar face to you, please introduce yourself. We have a super talented team that I'm really proud of, and all of these individuals work hard for you each and every day. Last but certainly not least, we are very excited to have Mary Ann Bartels in from New York. She just flew in this morning. Mary Ann is an award-winning market strategist. She has worked on Wall Street for more than 35 years, and we know Mary Ann from her long tenure at Merrill Lynch Bank of America. So both Carl and Brooke would tell you that Mary Ann has always been one of the best market strategists, market technicians, and we're super lucky to have her here with us today. I think I saw you last week on CNBC. She's on Fox Business and Barron's, Wall Street Journal. So we're grateful that she's here. And our plan for this evening, we're going to do, Mary Ann's going to speak for about 40 minutes. We're going to open it up for Q&A. So if you have anything on your mind, please use this opportunity to ask, and then we'll wrap right around 6 o'clock. So if you food, drinks, please feel free to continue to eat and drink throughout. Without further ado, Mary Ann.
Thank you, Lizzie. No, I'm good. They got me mic'd up. Okay. You're going to have handouts, right?
Yes.
Okay. Good evening, everyone. I know it's so hard to come out on a night like this. So, but I want to thank you all so much for coming. Yeah, I always try to prepare a little bit before I present, and I'm like, well, what am I going to talk about this evening? And I think it's pretty clear I'm going to at least get a question on the debt ceiling.
Probably not.
No, you don't think I'll get it? So I figured I normally would never start off with the debt ceiling. I just figured let's just get that out of the way. Are you all okay with that? So I never like to be insulting, but I feel like I'm dealing with kindergarten kids. It's but if you study it, the behavior of the markets during the debt ceiling. Now, we have raised or amended the debt ceiling 100 times since World War II. So this is not new. This is definitely not a new process. There are times where it comes closer to the wire. So they call this thing the X date, when the government's going to run out of money. Janet Yellen, who is the Treasury of the Treasury Secretary, says it's June 1st. If you talk to people, there's a few extra days, there's a cushion in there. Some people think it's really more like June 6th, but the market's very focused on June 1st. If that is the case, the Senate has to have something signed by May 30th in order for the president to be able to sign something to raise the debt ceiling by June 1. So those are just some dates for you. What markets generally do as the debate is happening is markets generally go down, they raise the debt ceiling, markets go up. The worst time in modern history was 2011, where they came down to the wire. They did pass the debt ceiling, but what happened is after we passed the debt ceiling, we got a credit downgrade. The US was a AAA rated in terms of our treasury paper, our government paper, and we got notched down by one letter. Right now, the rating agencies are not saying very much. In 2011, they were kind of hinting that they might do something. They were kind of putting pressure. Right now, they're not saying anything. So it'll be very interesting if the rating agencies start talking. So what do I interpret by that is right now the rating agencies are not hinting of a credit downgrade. There's a lot of chatter about a potential debt downgrade. So we have to kind of read between the lines. Nothing is, 100%. Right now, it doesn't look like the credit agencies are threatening a credit downgrade at the time that we're talking. But we only have 9 more days. That's 9 more days, and then something has to be done. Now, if they can't agree, they can kick the can down the road. They can temporarily raise the debt ceiling, but then we still have to deal with it, right? It's just kicking the can down the road. And again, markets have a tendency to be volatile as they're negotiating and then sell off. This period's been a little bit different with stocks. Stocks have actually been, or I should say select stocks, have actually been rallying during the negotiations. What we are seeing is short-term treasury paper yields rise. We just had an auction for the 1-month T-bill that actually breached 6%. So you're seeing actually more action happen in the short-term treasury market in terms of yields than we are seeing in the stock market, except for today because markets went down. Now, have the markets felt good this year to you? They don't feel good, do they? The S&P is actually up 7%. Yeah, it doesn't feel that way though. But if I tell you the NASDAQ is up 20%. Yeah, I know it doesn't feel that way. The markets are actually doing pretty well, even though we've had this extraordinary volatility. So the question is, will the markets continue to go up? And you should have a little handout. And if you turn the page, let's see what you got. There's a chart there. Hopefully everybody has a chart of the Dow Jones Industrial Average. It's a logarithmic chart. If you don't know what a log is, don't worry about it. If you know what a log is, you know why I did it. So it's irrelevant. What's important about the chart is, and the importance of using the Dow is, it's the first index that we have that has so much history. So this index goes all the way back in time, prior to World War II. You have the crash of 29 there in there. The most important thing about that chart is it moves from the lower left to the upper right. Our stock market trends up over time, but we have many big cycles around that uptrend, and they're called secular bull markets or secular bear markets. A secular bull market means you go up, but it also means you have bear markets. So what is a bear market? A bear market is defined by stocks going down by at least 20%. You can go down 30%. The worst bear markets are down 50%. But in a secular bull market, you will have a bear market, meaning stocks will go down 20 or 30%, but they recover and go on to record all-time new highs. And so you trend up over a period of time. Secular bear markets are markets that go sideways for a long period of time. And you'll see the lines. I've drawn them, so you don't have to figure it out. At least I hope they're on there. And so there are periods of time where we go nowhere, but generally during a secular bear market is the period where markets go down 50%, 50, and sometimes they will go down 50 twice in that period of time. But then eventually that will end and we resume into the long-term uptrend. So the question you should always ask yourself as you're investing is, where are you in the cycle? That's most important. We are in a secular bull market that began in 2013. How we measure that is you have to break to a new high from the previous all-time high in terms of the secular bear. So you have to breach above the last secular bear. Then you know you're into a new cycle, and that happened in 2013. A secular trend can last for 15 to 20 years. The greatest secular trend was from 1982 all the way up through 99, 2000 period. During that period, we had a crash in 1987. Right? My compliance department never wants me to use the word guarantee, right? I'm sure, right? Performance is not guaranteed, but I'll guarantee you, you will have a bear market. Bear markets happen. It is part of the investment process. In a bear market, the news is horrible, right? They tell you to buy low. Well, let me tell you, there's no good news on the low. They tell you to sell at the high. Well, that's all you hear is all the good news is on the high. Nobody wants to sell on the high because everything looks great, but that's when you're supposed to sell. Interesting, right? Investing's not easy. What I've learned to do personally is I just buy and hold. I change maybe a few things here and there. I'll tweak things here and there. But I've learned if I own things over the long-term cycle, and of course, I've studied this for my entire career. I know if I stay invested over a long-term cycle, that I will build wealth. The worst thing you can do is to pull out of the market out of fear and then try to figure out when to get back in. And the reason for that is most people, once they pulled money out, don't have the courage to go back in the market. And one of the time periods where I can understand why people took money out was 2008 and 2009. It was pretty horrific during that time frame. And we saw people take out money, but I also saw people never put that money back in the markets, and look at where we are today. Now, I guess we have to talk about banks. Some people don't want to call it a banking crisis. Some people are calling it a banking crisis. It's a banking event. We're having a banking event. We're having an event this evening. We're having an event with banks. I can look at it now that I'm older, and I can see easily the mistakes that have been made to why we've had a banking event. So for a Federal Reserve to actually have interest rates at zero and basically tell the world that they were going to stay at zero or very low for a long period of time, businesses make business plans. So if the Fed is telling you rates aren't going up for a long period of time, you're making a long-term investment plan. Well, regional banks made a long-term investment plan and they bought treasuries. And by the way, after 2008 and 2009, they're very limited in what they can actually own on their balance sheets. Basically treasuries and treasury-like very high quality paper. So they have their loan portfolio, right? Because you know how a bank works. They'll take your money. Not all the money sits there, right? They're lending it out. They have to keep a portion of it. And that portion that they keep, they invest, and they started buying treasuries and high quality paper, not expecting interest rates to go up. But then the Fed started raising rates, but the Fed did say that they were going to continue to raise rates. They did send that message, but the banks didn't do anything with their bond portfolios. And rates went from 0 to 5%. And I don't think anyone forecasted. I don't remember anyone forecasting that we would go to 0 to 5 in less than a year. Well, what happens when interest rates go up to a bond portfolio is the value of that bond portfolio goes down, because a bond has interest rates. As interest rates go down, the value of the bond goes up. As interest rates go up, the value of the bond goes down. They're inversely related. So interest rates went up, the value of their bond portfolio went down. So they have less assets. So do you remember that company called Silicon Valley Bank, SVB? Well, their bond portfolio went down, and they had a niche client, pretty much venture capital, private equity firms, and they had more demand for capital. So they were going to the bank and asking for their deposit back. Well, they only have a certain amount of deposits sitting there. So what they decided to do was to sell their bond portfolio. And they took a loss. Their advisor was Goldman Sachs. And they said, well, we'll sell the bond portfolio. You'll have this cash. You're going to have to take the write down. And because their capital ratios would change during that, they needed to raise equity. So they went out to raise equity. Guess what? Couldn't get the equity. Now they're in a problem. And that's why Silicon Valley Bank went under, because they had a mismatch of assets and liabilities. And the government had no chance, no option other than to take them over. There's a company called Signature Bank that they took over. I'm still trying to figure out that one. That is a total different animal. They had a bank. They were in crypto. They didn't have a problem. They were shutting that bank down, but the government decided to take them over too. So those two banks, the FDIC took over. Then you heard about First Republic. Now, First Republic started to see deposits leave because if you're a business person and now you found out that your money sitting at a regional bank, the only thing that's insured is at a limited amount of money. And most businesses have multi-millions and not even $1 million is covered. Well, what are you going to do to your deposit? You're going to take it to the big bank where you have more security. So First Republic saw a lot of deposits leave. They tried to help First Republic. The 10 largest banks actually gave money to First Republic for about 3 months while they could figure out what they could do to fix themselves. Well, what happened is they couldn't fix themselves. So the government took them over and Jamie Dimon of JP Morgan wound up buying the assets. So the question is, because now we're not talking about banking events anymore, right? That seemed to have quieted down, but can we have another banking event? What's your guess? Yes, we can. We're not done with this yet. The risk is we're not done, but it's probably played out over a long period of time. What the government has basically insinuated is that all deposits are safe in the United States. They do say that the banking system is solvent and it's funded, and that is very, very true. But if you have small regional banks and everybody starts taking their money out, a little regional bank could have a problem. As for the larger institutions, are they okay? Yes. Is your deposit safe? The government has basically said it's safe. Now, if they want to change the FDIC insurance policies of what's actually insured, Congress has to sign that. But Congress hasn't done anything because they're dealing with the debt ceiling. They can't operate. They can't figure out two different things at the same time. So, so I'm not sure we're done with banks. If you were to ask me what my crystal ball is saying, I think this is very similar to the S&L period. I don't think it's going to be catastrophic for the economy or catastrophic for the banking system. I think our banking structure is changing. And I'll talk about this at the end. This is my belief system. You do not have to accept my belief system. I'm just here to share. I believe, and I've been saying this for a long time, this is not a new revelation for me, that we are going to digital currencies. The world is moving digital. If you got anybody recently been to China by any chance? If you go to China, there's no money. There's no money exchange of any kind. Everything is electronic in China. We're moving towards 100% electronic transactions. Anybody have, a 15-year-old, a 20-year-old? Nobody in this room has a 15 or 20-year-old. Do they carry cash? They don't. Are you trying to stuff them like with some money saying you need? No, you've given up. Because I have my kids in their 20s. Do you have cash on you? No. So understand that our economy is going to shift, and this is not going to be our economy. This is a younger generation economy. The IMF has already announced that it has its own world digital currency. Has not gotten a lot of press, but if you Google it, you will find it. It is called the Uni coin. You will find it's very hard to say that because I normally say unicorn. I have to mentally really concentrate. So the IMF already has that, and every central bank in the world, any major central bank in the world is already trying to figure out its digital currency. So if we go to digital currencies, let's just do hypothetical, no opinions, but just think about a world digital. How many banks do you need? Probably don't need as many banks. If you look at Europe, does Europe have as many banks as we do? No. So I think we're in the early stages of a consolidation of bigger banks getting bigger and smaller banks getting smaller or being non-existent. So, and I think that's going to take years. So, and I don't think it's a big disruptive thing, but I think it's hard to invest in banks, right? I think they're undergoing a structural shift. There's a lot of value in very good, high quality banks, but I'm not sure that sector can take off until it figures out it's consolidation. Does that make sense? So I don't see them being leadership. Really what I'm saying is I don't see banks being leadership within the marketplace. It also tells me that our economy is going to be undergoing a structural shift at the same time. Now, why is that? What's on everybody's minds now? AI, artificial intelligence. Has anybody been on ChatGPT yet? Do you like it? Anybody like it? I'll tell you, you like it. The younger people that I talk to love it. And I'll give you an example. My head of marketing told me if she needs copy, like we'll do LinkedIn posts. If she wants to get copy from our advertising firm, she'll have to go to them, explain it. She'll get copy back in 4 days. She went to ChatGPT, gave it a couple of instructions, and within 10 minutes had a copy and posted it on LinkedIn. That's incredible productivity enhancement. AI is going to bring tremendous productivity. Is it going to change jobs? Yes. There's a lot of good. Everybody's talking about the real bad stuff, all about the jobs that are going to get eliminated, but it's going to enhance jobs too. And it's something we're going to have to figure out. Now, if you did not see the interview with the CEO of Google on 60 Minutes explaining AI, I strongly encourage you to find it because everything's out there. I'm sure it's on YouTube somewhere. He does a great job explaining AI. I will tell you that ChatGPT is an infant based on the technology that's already developed in Google. This is an infant, from what I can gather, infinitesimal component. But I think they're bringing it out for humankind to start getting used to and start adapting to. The one part of his conversation that I did not like is I found out that there's something called the black box. And the black box is where AI is doing algorithms and they don't know what it's doing. So the computer is computing, but nobody has any idea what's going on in that world. So take that or leave it. I didn't like that part too much. Because it's out in the system, whether you like it or not, this is the direction the world is going in. I generally tell people of my generation, this is not our generation. It's a little bit of our kids, but it's our grandkids and our great-grandchildren. This is going to be their world. Now, there is another page in your document. And I've been using this chart for a very, very long time. No, Key, let's see. Can I use you as an example? Nice paper too. High quality paper. All right. It's on page 3, but it's on page 2, but it's page 3 of the pages. So it looks like this. Thank you. I have been using this chart forever. This is not a new revelation. I've been using this at least probably for a good almost 10 years. And I want to take you 50,000 feet up in the air and really look at the US economy and what technology was really driving our economy. And we go back to the 1500s here. I don't remember it, but I did look into the history books. And we were agriculturally based. And the technology was a sundial, right? Farming was key to everything. It really wasn't until we created the steam engine in the 1700s that the US economy really started to shift and change. So at least starting with 1500 to 1700, that's 200 years, our economy was industrial. We believe the economy pivoted in 2000 when the internet was invented. Now the internet is a little bit, it happened in the 1990s, but we use 2000 because it's a nice clean number. But our economy has dramatically changed since 2000 with the birth of the internet. So that means we were industrial for 300 years. So the question is, how long will we be digital? And that's an easy answer. For your lifetime. And that's probably all you care about. right? So for the rest of your life, it's digital. And we've been saying this, if companies do not adapt to technology, they risk going out of business. So now with AI in here, I think the game is actually, the bar is raised. Now, this is really going to raise the bar of adapting technology in a business. And we have to figure it out. And it'll take time. But think of AI in terms of the importance of the technology. Think about when the first computer hit businesses. Now, I just happened to go to Wall Street in 1985. My first job when I first walked on the floor did not have a computer, did not have a PC computer in 1985. They existed, and I worked for a bank. I worked for a Manufacturers Hanover Trust. We eventually, I think in 1986 is when the first computer came on the floor and one person knew how to use it. So you had the PC, but nobody knew how to use it. My famous portfolio manager, which I'm going to figure out, he was about 55 years old at that time, who used, paper books to figure out all his information. I don't think he ever touched the computer, right? It was not his generation. But think about how computers enhanced technology over time in all businesses in ways that we didn't even understand back then. Now think about the invention of the internet. When we first got email, that was our first interaction with the internet. The internet was around for a long time. Only programmers knew how to navigate. And it really wasn't until we started getting software that we even knew how to use a computer. And what was really basically the first software we got, it was email. And if you didn't know anything about computers, you didn't know that the internet and email were two separate entities. Email was just the software on the internet. Now you see the internet and all the applications on the internet. Now think about, and that probably takes me back to my career in my early 90s, around 1990, 1992, somewhere around in that time frame. Now think about all the applications. Think about the handheld devices that we're carrying and all the apps that we have. Think about what's been created and what we can do. I can do banking on my phone. And I'll never forget when Bill Gates said that we would have an apparatus, because this was back when we had the Apple, I forget what they called the Apple thing where we listened to music and we had a separate phone. He said all of that was going to be one. He didn't even talk about banking being on there. And I thought that was weird. Now think about everything you do on your phone. And now we're going to bring in AI. AI, I think, is equivalent to the invention of the PC, to the invention of the internet, and where we go. I don't even think our minds are even capable right now of figuring out where AI is going to take us. But it's that pivotal and that important to businesses. So I think that's really, really important. That can, believe it or not, an enhancement in technology can have the stock market go longer, right? Cycles can be longer when you're developing new technology. Even the railroad, like when the railroad was developed, that was a huge, big invention and altered the economy. So I think AI will alter our economy in a way where we can have growth in the market that we don't fully can appreciate. The other part is all the money that the government has printed. And when I say government, I'm going to meld the Federal Reserve with executive orders from Biden, because they're all part of the government, right? Prior to the financial crisis, the balance sheet of the Federal Reserve was under $1 trillion. During the great financial crisis, they took that balance sheet up to $3 trillion. So they basically tripled it. That was a big deal. And they drove interest rates to zero. And that was to get people to spend money to take risk. Anytime a government goes to zero, they want people to take risk. The Fed tried to raise rates, tried to roll off the balance sheet, didn't work out too well. But when COVID happened, because that was such an unprecedented event where the whole world shut down, they took that balance sheet from $3 trillion to $9 trillion. It's mind-blowing. On top of this 9 trillion, and the Fed has probably rolled off maybe 850 billion from that. So we're a little bit off. So I'll just average, we're about 8 billion now. Biden has signed 3 major executive orders that add, and I think the projects are good. One of them is the CHIPS Act, right? Semiconductors, I'll get into that deeper. Remember, semiconductors are the brains of the operations of computers, right? And we're just going to need more and more computers. You're going to need more and more chips. Can't run a computer without a chip. Yeah, this is the CHIPS Act. So the not necessarily the largest, but the most important chip company today is in Taiwan Semiconductor. And they are building a $40 billion plant in Arizona. So there's incentives in the CHIP Act to bring manufacturing of chips to the United States because we are very dependent on our chips from being overseas. The Inflation Protection Act, which I honestly can't understand why it's called that, because I can't find inflation protection in it, but it does have a lot of infrastructure incentives in it, which I think are very important for our economy. So take this 8 trillion and this other 3 trillion that will come in over stages over a period of time. That's a lot of stimulus for the US economy. And I did a lot of building of models when I was younger to try to understand the economy. And I can honestly tell you that there's no model that exists today that knows how to take all this stimulus and figure out how our economy will behave. Hence why everybody keeps saying we'll have a recession, haven't had a recession yet, right? Hence why we're starting to finally see inflation, right? I think the days of deflation are over. I think this secular decline in pricing has ended. And I believe we're in a secular, yeah, I know. Yeah, we're in a secular uptrend now for inflation. But remember, cycles are long and wide. We're going to ebb and flow. If you look at a pattern of interest rates, even as we went down, it was up, down, up, down. There were periods of time where we stayed up for a period of time and down. It was 40 years from 18 to 0. The average cycle for interest rates is 20 to 30 years if you look at the long-term cycles. I think we've started a 20 to 30 year cycle. So I don't think you're going to see 0 interest rates again. I think that was the low. I do believe the economy will slow down enough where the Fed will eventually have to cut rates. I think we get rates coming down one more time. And I'm telling people, if you need a loan of any kind, that's probably the time that you lock and load. Because I think then you're going to see rates go back up again. I think we're in a cycle where rates will go up. So the question is, can stocks go up as rates go up? Yes, if the economy is growing. We have had great periods in history where interest rates go up and stock markets go up. What you don't want are rates that choke off the economy. And that's what the Fed is trying to do right now, because they're trying to slow inflation. They don't have a lot of levers to control inflation because part of the inflation came from supply shocks. Remember, when you're at war, you get shortages, and shortages also create inflation. So a lot of the inflation that we've had is actually because of shortages in supply. The Fed can't control that. So they really can only control part of this money supply now with the balance sheet, and they can raise interest rates. And they are trying to choke off the economy. They are trying to slow down employment. We have about 3 million jobs available, but we don't have 3 million people looking for jobs. That's part of the problem. That's put pressure on wages in order to attract people into employment. Now, Powell said something very interesting in his last statement after the Fed met and they raised rates by 25 basis points. We're looking for them to pause. I think as long as the data is supportive, they'll stay paused. We've had a softer CPI. We've had a softer PPI number. Those are gauges of inflation. This Friday, we get core PCE, which is called the price consumption expenditure. That's the Fed's favorite inflation gauge. If that can come in line or a little bit softer, I think the Fed stays on pause. But they've opened up the door. If inflation numbers get hotter, they can raise. I think now we're pausing for a period of time. We'll go lower and then go back up again. But with all this money still in the system, I still think, and this new AI and new growth, I think you're going to see more inflation, but you can't have the Fed choking off growth. So we're going to go through a cycle of them cutting off growth now. The lower wages growth will come back again. Inflation will likely come back, and then the Fed will do whatever it needs to do. But these are the cycles that Wall Street has always had. And even, I don't think we're the 1970s, at least not yet. It doesn't mean that we don't have a 1970s event in 15 or 20 years. And what I mean by that is where the Fed raises rates to an astronomical level. But if you said, Mary Ann, can rates go to 10% sometime? Yeah, they probably can. They will probably go to 10% at some point, but that might be 15 years from now. So, and I know we have a whole, so this brings up housing. The COVID bubble really bubbled housing, but there's parts of housing that's not going down a lot. There's some pockets that got very overpriced that will come down. Some will not come down a lot. Why? Because we had a shortage of housing for the millennials. By the way, prior to COVID, we had a housing shortage. COVID made it worse. I'm hearing up in the New York area, there's now a bidding war for apartments, right? Because a lot of young people don't have enough money to buy a house, so they're still renting if they're not living with you. So a lot of the young ones are still at home. I've got one. And we don't even have enough apartments, which is why you're getting bidding wars. So I think there are pockets of slowdown for housing, but I think housing longer term, there's very, very strong demand for housing. And I always think of housing as a monopoly game, right? And I really wish I learned that lesson of, remember how you bought the houses and you collected rent and you wanted Park Avenue? Yeah, that really does work in the real world, right? And when I think about housing, even when I started buying my first house, it was always too expensive to buy. And even my second house, when I bought my second house, I thought I had lost my mind, but I needed to buy a house because I moved states. And I thought, oh my God, I'm going to lose my shirt on this. Didn't happen, right? So when you look with housing, you want to look at demographics. You also want to talk to developers, because developers are still developing because they understand the supply and demand issues. What they're trying to manage are their costs, because a lot of their cost structures have gone up dramatically, right? Their wood and all the stuff that they need to actually build. But builders have not stopped building yet, which tells me they understand the long-term demand. So I think housing in general is okay. Commercial real estate. Anybody want to talk about commercial real estate? Yes, we have a problem in commercial real estate. I believe you have pockets of problems with commercial real estate, specifically office, right? There's a lot of different kinds. There's industrial commercial real estate. There's a lot of different types of real estate. The specific pocket that is challenged is office commercial real estate, primarily in big cities. Not exclusive, but primarily in big cities, because people are not going back to the office. Who owns most of those loans? Which banks? Small regional banks. Now, I just looked at a news article and I thought this was pretty interesting, that one of the banks that's been under stress in terms of the market putting pressure on its price sold its mortgage book to a private equity firm. I thought that was pretty interesting. So some of the banks are looking for ways to figure out what they need to do. But it does bring up what we call shadow banking, meaning entities that work as a bank but are not a bank, and private equity firms are one of them. But yes, that's where another part of the stress for regional banks is if they own loans on properties that wind up defaulting. But when I talk to people in the private equity world, the percentage of office space as a percentage of commercial real estate is small. It's not huge. So there might be things that definitely go under, but no one, and we've talked to a number of private equity firms at our firm. We've had access to a lot of intelligence. No one is looking for a systemic big blow up in commercial real estate, but the smart private equity firms are trying not to own office space. But there are some very large private equity firms that are out there that do own office space in major cities. Now, what I'm told is they're not 100% vacant. They might be 30, 40% vacant. So they are getting some money in. So you can maybe have some disruption. But what I guess my message to you is it doesn't look like it will be a big, large systemic event. I think the big, large systemic event will come from the Federal Reserve really trying to shut down our economy to stop inflation. I think that's the systemic event. And then we have to see if they overshoot, right? Tighten too much, slow things down too fast, and see what that fallout is. What else do you want to talk about? Okay, this is what I'm going to talk about. So let's talk about some good stuff, because now I just got all the bad stuff out. So where do you invest in the stock market? I've been a big fan of technology for a long time. I'm sure have you heard the acronym FANG? Right, so that's Facebook, but it's Meta now, it's Apple, it's Amazon, it's Netflix, it's Google, but then they had to make an index called FANG Plus because Microsoft's not in there, NVIDIA's not in there. Like there's a lot of big names that we think of that are not in FANG. Google, which is really Alphabet, so it really should be 3 A's. But anyway, gets all confusing after a period of time. These are real businesses, real companies, real technology. ChatGPT came out of Google. Google's sitting on a pile of cash. It's not going to zero. But what we've seen with a lot of these stocks is everybody's bought them, right? So I don't remember the Nifty 50 stock market, but I've heard a lot about it from my aunt that trained me on Wall Street, the people that lived through that 70 period. And the Nifty 50 stocks were a group of stocks that went up and then crashed. They got very, very expensive and then went down. What I'm told is it was more than 50 stocks. We don't even have the Nifty 50. We have like the Nifty 10, maybe even the Nifty 5. It is extremely narrow what's driving the market. What I will tell you, based on history, that is not sustainable. Just not sustainable. Something has to happen. You cannot have a stock market with 5 or 10 stocks. But I was listening to a very, very smart, very, very successful hedge fund manager, Paul Tudor Jones, if you know that name. And he's very insightful and obviously has a lot of access to a lot of smart people that I don't have access to necessarily. And he said something very interesting, which I found very surprising. And I'm still trying to figure this out in my head. He thinks markets will continue to do really well, even though we have this concentration, because we're going to get a very divided market because of AI. And I think there's some truth to that. I do believe there's some truth to that. But I also know you can't have a stock market with 5 to 10 stocks. So, and the valuations on them, on many of these companies are off the Richter scale. That, based on history, is not sustainable. But I believe in the sector. So how I've been trying to play it to try to stay away from these FANG-like names is just be in semiconductors and software and services. And I'll pick up if I'm doing a basket, you'll pick up in NVIDIA, which is a leading semiconductor chip company that I think even broke out to all-time new highs. And why semiconductor chips? I've been on the semiconductor bandwagon, I think, since 2012. My first job was working with a technology analyst, and I really learned how technology works in the cycle of technology. And the first thing that evolves is your chip. You don't grow technology without having a new chip. And we're making all these new chips. The other thing is we want to store all of our information. We are now a data society. They want data on all of us. Do you ever like talk about something and then all of a sudden the ads start? But yeah, they're tracking everything that we're doing. So, but they have to store all this data. So that's on the cloud. Well, what's the cloud? It's a computer. Crypto. All computers. I'm sure you've heard about the miners, right? That's all mine. That's all. You need chips for everything. So if we're truly in the digital world, right? So we're moving digital. So on that chart, we're digital. Well, what's going to drive digital? Semiconductor chips. So I'm fine owning a basket of semiconductor chips. You enhance your computer, but what do you run on it? Well, what does the chip talk to? Talks to software. So we're always upgrading. So ChatGPT is our new software, right? So I think the technology sector is very important. I think the industrial sector is very important because we do need a lot of infrastructure. We have an infrastructure bill, but I'll go off infrastructure for a minute. Aerospace and defense is in that sector. A lot of stocks last year in that sector were hitting record all-time highs because of the war. When you're in a war, you buy defense companies. Now think, the United States has committed $1.3 trillion, and some people in the military tell me that's a little low, but the number I've seen is 1.3 trillion from the United States. It's 2 trillion globally have committed to the war in Ukraine with equipment and all things. So do you think we're going to take all that equipment back? No, it's got to all be rebuilt. So aerospace and defense, and they're a leading technology. Those are leading technology companies. So, and that's in the industrial space. And then if you're going to build out and build bridges, if we're truly going to have a lot of electric cars, you need a lot more electricity. You learned that in California when they asked you not to plug in your car, right? So the power grid, we all know that the power grid needs to be updated. There's bridges, tunnels, roads, alts, right? So all of those companies that have that stuff are hanging out in industrials, and they're also hanging out in a sector called materials. So I think those companies will do very well. Anybody listen to the head of OPEC today? He basically said, watch out, because OPEC is meeting in early June. And the last time they did that, they cut supply to get the price up. They want crude oil at $100 a barrel. So I think energy stocks, energy companies really have created a great balance sheet. And when they get revenues, it goes straight down to the bottom line or out into dividend land. So I think the energy sector, as long as we're not drilling in the United States, because obviously we have the capability of drilling, we have the capability of being independent. But as long as that's not happening and crude oil prices are going to stay higher, the energy sector is going to do phenomenally well. What other sectors can we talk about? Consumer discretionary, those are things that you don't have to buy, but that you want to buy. Really don't like I think consumer spending is going to start slowing down. So you don't want to be in consumer discretionary. Consumer staples like food, soda, alcohol, tobacco. Do you know the funny part is every time we go into a recession, alcohol and tobacco do really well. The sin stocks do really well. Those are in consumer staples, but the stocks are pretty expensive, but there's some good quality companies that are hiding out there. Healthcare, as long as we have an aging population that wants to be on 15 pills a day, because there are some people on 15 pills a day, healthcare is booming. It's a booming industry and it has the demographics behind it, right? It will have cycles, right? We'll have ups and downs, but healthcare is a long-term bull market unless we find a simple cure for something, but they just seem to want to keep giving us pills. So, and vaccines, no judgment, but they're pumping out vaccines, they're pumping out pills. And as long as the consumer is buying, those stocks are going to do really well. And then you have the invention with the biotech companies. So I think there's a lot to the biotech healthcare story and just drug story. And those are almost all the, not all the sectors, but the main ones. But I think I can open it up for questions so I can really now talk about what you want to talk about. I can talk a little bit about crypto if you want to talk about crypto. Okay, I got a yes. Okay, so I retired from Merrill in 2020. Unbeknownst to me, COVID was coming. So I got locked in. I got to Wall Street because my aunt went to Wall Street. My dad's baby sister went to Wall Street in 1956. And she didn't want a career on Wall Street, but wound up with a career on Wall Street, wound up with her own newsletter. And some of you might remember Wall Street Week with Louis Rukeyser. She was one of the L's that was on the program. She was on the program for almost 25 years. And she didn't have children, and she wound up having dementia, and she wound up living with me. So I took care of her during COVID. Unbeknownst to me, that was her last year, and she passed. And I'm like, all right, after I got through my grieving process, I'm like, I'm sitting here twiddling my thumbs. And I really thought there was something to Bitcoin. You know, I just get these gut feelings, and I'm like, there's something there. I said, I got to figure out what it is. So I started taking courses, and I have all these certificates now. Let me tell you, it was a pain in the ass. Absolute pain in the ass. Brought me back to when I worked with the technology analyst, because that was 1987. I didn't know anything about computers. I didn't know any computer terms. There were no dictionaries. And I had to learn all these new terms, all this new language. I eventually got it, but it was a real pain in the ass. Well, I felt like I was doing that all over again. All new terminology, infrastructure is different. But I think I finally got it, but it is a very fast-paced, growing and changing space. So things are constantly evolving, but I can give you the very brief 101s. Bitcoin is a currency. Think of Bitcoin as electronic cash on the blockchain. So the blockchain is really the new technology outside of AI. I had the privilege of interviewing Jenny Johnson, the CEO of Franklin Templeton. There's a podcast out there. She has a great line. And her line is that Bitcoin is the greatest distraction of the greatest evolution in technology. And that's the blockchain. Blockchain technology, think of it as you have a transaction, and then another transaction that's related to that is linked to it. And then another transaction gets linked to it. So you get, everything gets linked. And in cyber security land, it's harder to hack. But what I've learned from computer people, everything is hackable. But it's a technology that's it's the strongest technology we have for hacking. So blockchain is the technology. And then you have the internet. Crypto, the Bitcoin, is the e-cash that's on the blockchain. Now, we don't know who created Bitcoin. That person is anonymous. They have a pseudonym, but nobody knows. There was a white paper that showed up on the internet. Some smart people found it. By the way, I've read the paper. It's less than 10 pages. No, I could not understand everything because it's cryptography. And that's not my area of expertise. But he solves a very important, and we're not even sure if it's a he or she, but the name sounds like he, solves a very important computer complex problem. And people figured it out. And the adoption of it, you can only, in the design of it, I should say, you can only create 21 million Bitcoin. That's it. It's designed to be like gold. So Bitcoin is real, and the SEC has confirmed that it's a currency because they've approved of futures on it. So Bitcoin is real. Bitcoin is not going away. Ethereum is the second largest cryptocurrency. That is not a currency. All these other things that they call currencies and tokens, they're not currencies. It was the greatest invention to avoid the SEC, to have a company raise money and not have to be registered. They bypassed it. They are security companies. I believe they are. I figured it out before even Gary Gensler started talking about it. I'm like, these are companies. They bypassed the SEC. I said it was absolutely brilliant. Ethereum is a technology, a software technology that sits on the blockchain. Think of Ethereum as the internet. So this is called Web 0.3. So now I'll get into terms that most people don't know. So I'll try to think of Ethereum as the next evolution of the internet. So all this crypto stuff is taking the internet to the next level. We don't know who the winners or the losers are going to be. Bitcoin, I believe, is a winner. Ethereum is the winner. Think of Ethereum as the Microsoft, like that's the Microsoft of the internet. Think of Ethereum right now is the Microsoft on the blockchain, but we don't know if it will eventually be the Microsoft. It wants to be. Most people are building on it, but it has competitors. But this is all the early stages of being a digital world. We are going all digital, and each platform will be built, and this whole blockchain, cryptocurrency, NFTs that are called non-fungible tokens are all part of this new evolution. As I said, this is probably not our generation, maybe some of our kids. It's really grandkids, great-grandkids, unless the technology really speeds up. And it does, with AI, does have the ability to do that. We just have to learn how to keep up with it. And with that, I'm happy to take any questions.
That side of the business, you think EVs take a lot? Look what mining companies.
Oh, minings need a lot of energy.
And just a comment on an EV guy, there's plenty of power. It's just how we balance it out in the system to charge those cars. But to your point about power, that's why the shortage that we have is because of the.
Yeah, the mic's not working. I want people to be able to hear you.
Test.
May I be closer?
There we go. Do you mind starting from the beginning? Because it's an important conversation.
Okay.
You're an EV guy.
Yes.
We have enough power. We have to learn how to distribute it.
Correct.
Okay.
And when you start talking about crypto mining and the power those facilities require, makes the EV world look pretty small.
Do you want to know, I have a friend that actually heats his house with the mining machines. They generate a lot of heat too.
So that's my point, is that really energy is the big problem in this country and globally about how we handle all this. So, but anyway, my point was that crypto, talk about power, EV, plenty of power for that. We just need to regulate those waves of demand. But I don't know how we're going to absorb the crypto mining, that's going on. How that's a balance. That's a lot of power that's used like all the time. So the peaks
It's
are really going to
24/7.
Right.
In fact, they're already working on developing, having stocks, bonds, everything on Wall Street trade on the blockchain.
Then I have one other question.
They're going to tokenize Wall Street.
Can
They're
you
already
talk,
working on it.
Can you talk a little about the decoupling from China and the effect
Decoupling from China.
on the effect on the global manufacturing world and industrial world?
Sure. So we're onshoring. So, and that's part of why we're going to have a more inflationary environment. We learned during COVID that if you have your supply concentrated in one location, you can't necessarily get your supply, it's a problem. So we're in the early stages of what's called onshoring or nearshoring. We're going back to Mexico, Canada, and that's going to cost more money. And that will wind up going into pricing. So that's part of the whole long-term structural shift in the trend in pricing being more an inflationary environment. I think when I think of China now, it's more at the seat of the table of we're back kind of in a Cold War that we're trying to be friends with a Cold War enemy. China is really now starting to make a stance politically. So what do I mean by that? They brokered a deal, China with the BRICS, with Saudi Arabia to deal in crude oil in non-US dollars. That's huge. We've been doing crude oil for 50 years in US dollars. China said it was going to try to broker a deal between Russia and the Ukraine. right? You're starting to see them step up and try to have now political influence. So I think there's a major shift in China trying to be very present in a political sense. And we're trying to navigate that. You're seeing Biden try to navigate that. He has strong language, but he's trying to negotiate. China reopening has not really had all the growth here in the United States that we thought would happen from the opening, but it's actually had a positive influence in Europe. The one thing I didn't talk about is the US relative to investing outside of the United States. There are many times you only want to invest in the United States just because it really works. Not based on models, because the models will always tell you to diversify outside of the United States. But there are periods of time you want to diversify outside of the United States. We're probably at that pivotal moment because the US market relative to a lot of other markets is very expensive. Europe being pivotal. Emerging markets are very cheap, but there's a lot more risk structures that come with that because of China, because they're a big emerging market. I didn't talk about commodities. I do think the next cycle, we're going to have a lot of demand for commodities, especially for this infrastructure. So I think commodity and commodity related sectors will do well. We have to treat China differently because it has more of a political presence and it's threatening to take over Taiwan. And there are many people in military world that think that could happen as early as next year. So I think about, well, without having an opinion, just an observation, if China was to go in and take over Taiwan, what would the stock market do? Everybody in this room can answer that. It's going to go down. During war and war that could affect us, right? When people ask, when things are happening outside of the United States, and a lot of them tend to be more humanitarian, they say, well, can this affect the United States? I said, no. I said, it's a humanitarian crisis. As long as you don't impact the economy of the United States, it doesn't matter. It doesn't mean that it's not a tragedy. It's when something impacts our economy, our markets will respond. I believe if China takes over Taiwan, that would be huge. And a lot of that has to do with chips. And I think I've kind of explained the importance of chips, and the #1 chip company in the world is sitting in Taiwan. It will have huge ramifications. But even if that happens, markets go down, they come back again, because then the Fed would have to really cut rates again. Maybe that's one instance where rates get very low, because they would have to stimulate, because a lot of shortages would happen, right? Because now you're going to also have inflation. There's no good answer to that one. So I pray all the time that doesn't happen. So China, when it comes to China, we have to think of China very differently than we thought of China 10 years ago. China is very much on the political platform. How does that get passed? Yep, and that's Taiwan Semi that's actually building that. Yeah, no, but it's not going to be built by next year. So it doesn't help us.
No.
Okay, so Intel was the chip leader for decades. They've gone to the back of the pack. They literally were #1, now they're last. But they're not going to zero, but they're behind the pack. They have to do a lot of catch up. They're not the top innovator anymore.
So Mary Ann, if currencies are all going digital, how do the central banks control that?
Okay, so if we're going digital, how do the central banks control that? They control it by having their own currency.
You think the dollar will
The US dollar will become obsolete. Yeah, you can get a table, get all the currency, put it in it, and when the grandkids and great grandkids and say, this is what we used to use, and they'll think it's really funny. Will make no sense to them. But how we transition that day to go to digital, I don't know how that happens, but we know that every major central bank is looking at developing and issuing its own currency. Now, in crypto land, we have what's called stable coins. And there have been stable coins not backed by US dollar. We have stable coins backed by US dollar. The stable coin that was an algorithm went bust. And I knew that was going to happen. You can't have nothing. But there are stable coins that are backed by dollars, but they recently broke the buck, even though they have dollars. When during the banking crisis, they actually did break the buck. I don't, in my personal account, if I want to own dollars, I own dollars. I don't own stable currencies. The reason why stable currencies and part of crypto was even created, the younger generation doesn't like our government and doesn't like our banking system. They want to be independent. They also want to be able to move money freely. The crypto space, because miners are never shut down, the computers are never down, you can deal 24/7. I mean, I sent money overseas in a matter of seconds that would normally take me hours, if not days. So there's a lot of beauty to blockchain and crypto because it's a ledger and everything is recorded. It's authenticated. I think you're going to see NFTs of buildings and people are going to buy pieces of buildings, artwork. It's mind blowing when you enter that space. And I didn't even talk about the metaverse, but the simple thing of metaverse is just watch an episode of Star Trek and go on the holodeck because that's the metaverse. The metaverse I don't get. I get it a little bit, not the bigger fan. I'm going to be very big in gaming. Well, I went off track. In terms of digital, I don't know how they do this whole shift. I don't know if it's hugely disruptive. What happens if the power goes out? And I just lost power to my waterless water tank. And I woke up and I had no hot water. Well, what happens if we wake up and there's no electricity and everything's electronic? Anyway, those are the things that I guess I don't need to worry about, but it goes in the back of my head. But yeah, we're moving, regardless of all of that, we're moving digital. We're into the world of digital. It's happening, but I don't know how or when. But I write about it occasionally.
Isn't the dollar really digital too? I mean, most transactions are electronic, Visa card.
Yes, but it's not a currency. It's a credit card or it's PayPal, but it's not digital. But they will make a digital currency that's the US dollar. But I don't know what they'll call it. But as I told you, the IMF already has the uni coin. So that's clear signs that we're moving in that direction. But I found it very interesting. It didn't get a lot of press. Could easily miss it. Any other questions?
What are the dangers of
What are the dangers in
going digital?
dangers of going digital? Massive disruption where things don't work. Remember Y2K? Think about Y2K, how we panicked about going to Y2K, but I think it was good because we panicked and everybody made sure that everything was ready for Y2K. Maybe they have to do something like a Y2K to be able to do that flip of the switch to switch. Or they run a dual system for a period of time. I have no idea what they're thinking behind their heads. I just know it's happening.
Where's gold in relation?
So where's gold? That's a great question. I think eventually gold goes much higher and silver goes much higher. So if there's any disruption, we'll default to probably gold or coins. It's always been a store of value, right? Never really made anybody a lot of money though. You don't earn anything on it. It's an insurance. I always think of it as an insurance policy. You actually do better in the stocks. Many times you'll do better in the stocks, especially if you collect a dividend. But it's that insurance. Like when I used to meet with my clients that came from Mexico, there's been histories. There's been times in Mexico's history where the government just came in and took everything, right? So some of my ultra high net worth clients had a safe somewhere in their house and had gold. That's part of how they live, that they always have something because they've just seen wealth knocked out. And there was a time in US history where the government took everybody's gold. I just can't remember the date off the top of my head right now, but there is a time where the government came in and took gold. So, but I do think gold will not work in the near term, but I think in the coming years, gold, if it breaks out to an all-time new high, can go much, much higher.
Favorite dividend stock?
What are my favorite dividend stocks? I don't really have any. I didn't bring any with me today. I'm sorry. I didn't bring any of my favorite stocks, but I love dividends. I'm very old school. You know, my aunt trained me, you know, high quality companies collect a dividend. I'm very happy with that. But I don't want to detract, you know, not everybody likes that strategy, but that's, I grew up old fashioned. Any other questions?
Mary Ann, I can't thank you enough for coming.
Oh.
Mary Ann?
Hello, it's that mute.
All right, well, I can't thank you enough for coming.
Oh, thank you so much for
Uh,
having me. Thank you all very, very much. Thank you.
We were big fans of yours when we were at Merrill Lynch, and to know that we have access to you again and that we get to follow your commentary, it's amazing.
Oh, thank
Yeah.
you. Thank you so much. Oh, I hope you enjoyed it. I hope
Yeah.
you found it useful.
Thank you for coming, and thank you. And thank you for those who watch us on live stream. We'll be circulating the deck after the event, so you can see all of Mary Ann's slides. And, you know, of course, reach out to us if you have questions or want to talk further about any of the topics we covered today. Again, thank you. So there's food and drinks, so please help yourself and have a good time.